very briefly, this is obviously an extraordinarily important topic at the absolute forefront of what macroeconomists are concerned about now. We are very lucky to have an extraordinarily distinguished panel headed by a moderator, Rajan, who is the Catherine Dusak Miller Distinguished Service Professor of Finance at Booth. And I will let Raghu do any other further introductions as he sees fit. So the format is yours, Raghu.
Thank you, and good afternoon, everyone. What I hope we will see is three fantastic minds talking about a very important topic, trade-offs of a higher federal debt. We have Larry Summers, former Secretary of the Treasury, former President of Harvard University, and currently the Charles Eliot University Professor at Harvard University. Richardo Reis, Phillips Professor of Economics at the London School of Economics, and Carmen Reinhart, who's currently the Chief Economist at the World Bank, and also the Minos Zumbanakis Professor at the Kennedy School of Government. So rules of the game, we start with 7 minutes per person with a 1 minute warning at 6 minutes, after which I start talking loudly so that I interfere with your conversation. That's to convince you to get off after 7. 7 minutes per person, and then we go into a discussion where I will ask questions, and they will be pointed at someone, but then others feel free to respond. Others on the panel feel free to respond. The audience, feel free to ask questions via chat, and I'll try and put them into the conversation. But maybe after an hour, we'll have an open session where anybody can ask, and if it gets unmanageable, perhaps you can ask via me, but let's see how that plays out. For now, we start with opening statements by the panelists. I need Larry Summers to start, but he is missing. So Richardo, if you are prepared to start at this point, perhaps we'll turn to you for your 7 minutes.
Sure, absolutely.
Oh, Larry's here.
Larry's just
returned. He's just in time. Larry, are you there?
You're on mute.
Okay, Richardo, why don't you start, and we'll get Larry on second.
Okay, great. Everyone can hear me? Yes, I guess so. Well, thank you very much for the invitation to be part of this panel. Raghu had asked that in this initial intervention, I focus on what some of the domestic trade-offs are of having a large debt. And importantly, what have we learned about government spending and debt, both looking back as well as looking forward. And I wanted to make 3 points in this initial intervention. First, on what are the trade-offs for public spending and public debt during a pandemic and a lockdown. While the US may be looking at the pandemic in the rearview mirror now as vaccination advances, it is important to keep in mind that this is not the case almost anywhere else in the world. France just entered lockdown a couple of weeks ago, and many regions in Europe are facing a third wave, not to mention that most emerging markets will be vaccinated in 2022 in the best case scenario. And actually, even in the US, of course, Michigan is still peaking, and as new strands emerge, it may be that more lockdowns are on the horizon. I think one trade-off that we learn is not so present is the old classical crowding out trade-off. When we have a large aggregate shock of a temporary nature, the ability of the government to borrow from the future and allow for intertemporal smoothing seems to be key, important, both in providing for consumers, given gaps in social insurance, as well as for employment, as the churn in labor market that, for instance, we were learning about from Bob Hall and Mariana Kudliak earlier may induce slow recoveries, and finally for firms and sectors as differential effects may lead to long-term scars. Instead, the trade-off is between the targeting of these, not targeting in the micro sense, but if you want more with a macro goal. Should one privilege firms in providing support, as was in some ways done in Europe, or should one privilege firms and keeping existing employment relations, or should one privilege households and the unemployed? Should one have broad policies that send a check to everyone, or should one have very targeted ones that only send check to those that are deemed to have been more affected or whose impact of the pandemic will be higher? Important in those is the trade-off between administrative speed and effective targeting, as we have learned. But importantly, during a pandemic and a lockdown, the government seems to have a role in stepping in, borrowing largely from the future, and then worrying more about how the targeting of these is. Second point is a trade-off in the recovery. And here, if you want, under the broad name of stimulus. If you look at the last 12 months, and if you only look at AGA data, you would think that the Ricardian model of consumption of Ricardian equivalence is just right. The government sent checks to people, people deposit them in banks, banks deposit them at the central bank, and the central bank bought government bonds. Now, at each of these steps, there were leakages. Some of the checks were spent, some were put in stock markets as opposed to deposits, then the Fed, and the Fed didn't buy all of the government debt, certainly, or the central banks are, not the Fed, this is true broadly in advanced economies. But it is quite striking how on aggregates, if you only looked at aggregates, the Ricardian model wouldn't be too far off. Government savings were matched by a large increase in private savings. And indeed, even if you look cross-country, the countries in which the governments had larger fiscal packages were also the ones in which savings rates increased more and more persistent. And likewise, the timing of those government borrowing seemed to coincide with the timing of the spikes in savings. Even if you look at microdata and heterogeneity, that certainly places more of a challenge because you see poor households with very large marginal propensity to consume, that is spending the checks as opposed to saving them in their banks. But even then, simply allowing for borrowing constraints on the poor, or just the fact that many of the poor are not going to pay any of the taxes against the transfers they received, you would end up with, again, a representative agent permanent income hypothesis model, as say in Bob Hall's seminal work, didn't do badly at all. Rather, the main objection is not the microdata, say, is rather whether these were voluntary savings or not. Were they indeed saved to pay for future taxes, as Bob and Robert Barrow and many others taught us, and Milton Friedman, or rather were they because one was unable to spend? That is, in many ways, the key trade-off that will come up now in the stimulus, when one talks about stimulus and recovery, Looking forward, it says that the discussion of marginal propensity to consume, Keynesian cross-type effects, are in some ways not quite the point, the thing to emphasize. Those are about marginal propensity to consume out of income, but it's rather the marginal propensity to consume out of these past savings, out of wealth, if you want, that becomes the crucial determinant of what will happen as we move away from the non-Ricardian world. Maybe the Ricardian world will just continue, but as I think we'll move away from the Ricardian world in the last few months. In the dominant models that I think we have are those of precautionary savings. And in those, the prediction of those, if you put them in your computer, it says that the spending should happen very quickly. Why? Because in those models, there's a very strong force of buffer stocks. You would want to converge back to your buffer stock of savings. But if so, that savings will come with a rise, a quite significant rise in real interest rates. Third trade-off, the trade-off in the future of the debt. The gap between G and R, the growth of the economy and the safe interest rate on government debt, is the relevant one if one wants to think about one-off deficit gambles, a very large increase in spending that's very short-term and that will be rolled off by buying a long-term bond. Now, note that in the US, in the UK, certainly in Europe, that is not what happened. We did not lock in a long-term interest rate. Quite on the contrary, through quantitative easing, we have moved the maturity of the US debt privately held has become, if anything, shorter. And secondly, this was not a one-off deficit gamble as recurrent spending has become the norm and more spending plans are announced. Now, for recurrent spending that will be rolled over, more relevant than R minus G or G minus R is rather the gap between the return on private assets and the return on government bonds. Call this a measure of convenience yields, of bubble premiums on the debt, of seniorage. They're driven by safety or the liquidity of government debt, by whatever it is that make government bonds special. This is the source of revenue on the debt, and that is
one
what
minute more. 1 minute.
Financing the debt will depend on. On that, and understanding that is the case, that then leads to some trade-offs, of which I will highlight three. First, that if we are financing recurrent spending that we're rolling over, as we certainly seem to be, then inflation risk, as the one that has risen in the last couple of months, is very worrying because it endangers the safety of government debt relative to, say, real investments in the private economy. Secondly, that market freezes in treasuries, as happened in the last March, or even relatively low coverage in auctions for treasuries, as happened just a month ago, are particularly worrying because they question the liquidity of the government debt. And thirdly, and still in trade-offs, that spending on infrastructure that potentially raises the marginal part of capital and therefore leaves the key gap between MPK or M and R, the interest rate on debt versus the return on private capital, well, spending infrastructure has the potential to, even if R goes up, that M will go up as well, thus allowing for the financing through this gap, where they're just pure transfers, where probably at best just neutral with respect to M or the marginal part of capital are certainly more worrying. So those are the three trade-offs that to get the discussion started. I think I'm just out of time, so I'll stop there.
Thank you very much, Richardo, and for sticking to the time. Next, we have Larry Summers. Larry, are you with us?
I am. Thank you. Thank you, Raghu. Thank you for the invitation to be here. I find what's happened in the last year in terms of fiscal policy to be the most remarkable policy experiment that I've ever observed. Let me just give a little context on my views. My views from about 2012 onwards emphasized what I thought was an emerging major macroeconomic issue, which I call, rightly or wrongly, secular stagnation, but had as its essence that at extremely low real interest rates, the nature of private savings behavior and private investment behavior was such that with historically normal fiscal policy, the economy was going to struggle to get to full employment and was going to have a deflationary tendency. And therefore, the large issue for macroeconomic policy was much less containing the excess appetite of central banks to print and the excess aptitude of governments to spend, but was to ensure sufficient savings absorption along with microeconomic efficiency and to push us to full employment. And I regarded the fact that from the time I said that in 2013 till 2019, we had much more deficit spending than people expected, much lower interest rates than people expected, much more expansionary monetary policy than people expected, and yet slower growth and less inflation than people expected as being broadly corroborative of that set of views that emphasized savings absorption as the problem. And in general, I felt that pre-existing understandings about fiscal policy needed to be modified, both in light of the savings absorption problem and in light of the reality that secularly lower interest rates meant that whatever kind of reasoning produced the Maastricht criteria when the real interest rate was 5.5% needed to be different when the long-term real interest rate was 0, with all that portending. Never could I have imagined that any set of events would call forth fiscal stimulus on the level that we have seen or are now seeing in the United States. As a rough approximation, the Obama stimulus, which was derided as too small, represented about 2.5% of GDP in 2009 against a GDP gap that was judged to be 6 or 7%. In contrast, the current stimulus represents 14% of GDP against a gap that is regarded as being in the neighborhood of 3 or 4%. So relative to the gap, we are engaged in fiscal stimulus on the order of 7 times as large as the Obama stimulus. Maybe the Obama stimulus was too small, probably it was, but I'm aware of no critic who suggested that it should have been 7 times as large. To put the point in a different way, the usual concept to which we fall short is that fiscal policy might be energetic enough to prevent disposable income from falling at all during recessions. The idea that fiscal policy should be sufficiently expansionary so as to lead to large increases in disposable income. And I think it's plausible that the disposable income of the bottom fifth of the population will rise by 1/3 this year relative to any pre-COVID benchmark, was something that was kind of unimaginable. And so it seems to me that this is being coincident with extremely expansionary monetary policies on almost any measure. And so either the kinds of forces associated with secular stagnation arguments, depressing private consumption and private investment, are going to be operating with extreme force, or it seems to me that we will have demand being created in substantial excess of capacity with likely inflationary consequences. Will the, or we will have some substantial undoing of the current policy path. Will that take place in the latter part of this year? Will it take place in the middle of next year? I don't think anybody can have a confident answer. But it seems to me that unless one believes that policy is going to be substantially adjusted, either because the fiscal policy is going to be phased out very quickly, an idea that looks increasingly unlikely every time political leaders explain that what they're most proud of is that they're doing the biggest revolution in policy since the New Deal and the Great Society, which is completely inconsistent with the idea that it's going to be phased out very quickly. Or there is a substantial monetary policy adjustment. It seems to me that an overheat with substantial consequence, either in measured product price inflation, unsustainable asset price inflation, or monetary policy adjustment, which is likely to take place not smoothly, is a very high probability. And I have to say that the arguments being made by policymakers that emphasize anchored expectations seem to me almost entirely inconsistent with their constant claims that it is a whole new world of policy with an entirely different rejection of the neoliberal order on the part of macro policy and a new caring and compassionate Fed and IMF in the area of monetary policy. I am struck that in
Larry, 1
response
minute.
to what seems to be a much smaller increase in fiscal policy to meet urgent objectives and a much less accommodating monetary policy during the Vietnam War period, inflation went from having a 1 handle in 1966 to a 6 handle in 1969. So I find the choices we're making stunning, the risks large, and the general commentary of the profession, which, with the exception of Olivier Blanchard, who characteristically less vivid ways, has said the same kind of thing I just said. But in general, I have been amazed that there is not more commentary on along these lines, and I'm hoping that somebody's going to explain to me why I'm basically wrong to see this as a huge overshot in taking on board the secular stagnation idea. And I feel a little bit like somebody who was advocating a minimum wage increase from $7 to $14 or $7 to $15. And then they went and proposed a $22 minimum wage. And they didn't know quite what to say because it was kind of in the direction of what they'd been saying before, but it was just way disproportionate to the problem.
Thank you, Larry. Carmen.
So Raghu, I think you had asked me to talk about the risks. Where are we? Are we approaching the risk? And primarily to focus or to focus on advanced economies. So just as a recap, I hope I interpreted that correctly. I think I'll start with the observation that 15 years ago, the consensus view was that sovereign defaults only occurred in emerging markets. And at the time, I remember having debates when it became clear that the situation in Greece was one in which was unsolvable without a debt restructuring. That view was very much in the minority until it became evident that was the case. Why do I start that way? I think that the reason I chose to start that way is never say never. You asked about risks and the advanced economies, and the advanced economies encompasses periphery Europe, and it encompasses the US with the world's reserve currency. So I think the nature of the risks, first of all, are we in the danger zone? Secondly, what are the nature of the risk? The nature of the risks is different depending on where you sit. The idea that, I've never embraced the idea that high levels of debt are something benign. I think even absent drama, even absent a currency crash, a default, an inflation spike, even absent all of that, I think high levels of debt historically at least have not been associated with sustained, and I don't mean cyclical ups and down, I mean sustained averages over long periods of time, high levels of growth. So I think for a variety of reasons, which also include that higher levels of debt, I think at some point do create constraints do create constraints for central bank policy. They create constraint for responding quickly, although certainly what we're seeing is an exception to that. But in general, higher levels of debt have been associated with slower responses to adverse shocks. And I think we are going to discuss a central bank issue later. But I would add that if you look at accidents through history, I've not encountered cases of where the concern is our debt is too low. That really hasn't come up. It's generally you're in a multiple equilibria region. You're in a region where bad shocks can pivot you in an undesired direction. And what might those shocks look like? I think, we're all used to, the headline numbers, Italy's very high level of debt and so on. But to me, going back, and let me start with periphery Europe, then I'll work to the US very quickly. Let me start with the observation that ahead of the global financial crisis, there were two countries in Europe that already, before the crisis, had debt to GDP above 100%. One was Greece, the other was Italy. Here we are more than 2 decades later, and today the per capita level of income in Italy is below what it was 20 years ago. And the same is said for Greece. That's an outlier. In the per capita levels of income in the US and other countries are to the order of more than 20% higher than where they were too. So that's just on the point of growth. But let me turn to what it might look like. What might it look like? And here picks up where Larry left off. I think in a high debt world, central bank responses are going to be constrained and not going to be constrained symmetrically, meaning central banks are going to be much more willing to lower rates if they can than raise them, precisely because of the concern that you have very highly indebted countries and very highly leveraged private sectors as well. So from both the cost of, the potential cost of financing and from a financial stability, I think the nature of the game has not only changed for fiscal policy but for monetary policy. And I think that is likely to impart an inflation bias in central banks. I've noted in the past that the heyday of central bank independence was not accidentally taking place after the inflation surge in the advanced economies at a period in which actually levels of public debt had gone down to their post-war World War II lows. So that's one type of risk. The other type of risk, which is more germane to in the advanced economies, and for the US, I think one of the things that gives the US quite a bit of rope to have done what it's doing is the fact that as far as I'm concerned, there are no viable alternatives to the US dollar as a reserve currency. So the rest of the world is, willing to buy a lot of US debt. That can mitigate things that we can talk about the Triffin dilemma, perhaps in the Q&A, and revisit the Triffin dilemma, the modern Triffin dilemma, which is sort of a day of reckoning in which the rest of the world doesn't have to reject the dollar. It never did in the last round, but scales back. And that can be a currency crash, and currency crashes, which have happened and did happen, can also add to the inflation story. That's one type of risk. And I'll stop on the more classic risk, which is a replay on a grander scale of what we saw after the global financial crisis. Greece, Ireland, and Portugal combined have a level of GDP that is smaller than Italy and Spain, certainly. I would add, I'll stop right here, that if the underlying levels of debt for Italy, for example, which, has already, a debt of about 157%. And for Spain, debt of about 118. These don't, and I have no time to go in detail here. These don't include even the target 2 balances, which is an IOU. It's debt from central bank to central bank, from the Bank of Spain to the Bundesbank, from the Bank of Italy. And those are running to the tune of 40% of GDP for Spain. So 118 becomes over 150, and almost 30% for Italy. Let me stop there. That does pose the risk of more of a scenario on a grander scale of what we saw after the global financial crisis. So there are different kinds of risks for the US and different kinds of risks for periphery Eurozone.
Thank you, Carmen. So let's go through a few rounds of questions. Then I'll come to the people who've raised their hands, and I'm taking note of who's raising hands. Larry, I want to take off on your point that the profession itself has expressed little surprise. I mean, here's a pandemic which is obviously tragic in its effects. The human toll continues to be felt every day. But you wouldn't know, seeing the growth forecasts for the United States, tremendously strong for this year, of course, virus willing. So have we found a new tool to deal with downturns? Massive government spending with easy monetary policy where everyone is happy, except perhaps those who've slipped through the cracks. Corporations are happy, banks are happy, even the IMF is happy and is saying only don't stop too soon, just keep continuing and don't end abruptly. So we've achieved the economist's dream of painless downturns. What's different? I mean, why is it that this is happening now? Is it that this is a different kind of animal from a normal recession, and therefore these tools might work? Is it that the political economy of spending now is different because of the issues in the United States, but also the nature of the pandemic? Or is it something else? I mean, you're obviously suggesting this is not going to be an effective tool, but why did we embrace this, and why is there so much consensus behind it?
You can answer your question at many levels, Raghu. Just first, a fact that might be helpful. The shortfall in labor income, compensation of workers, estimated relative to a pre-COVID trend, is on the order of $20 billion a month. You might argue that it's, as of now, you might argue that it was $30 billion a month. You might include some proprietors' income, but we're in the $20 or $30 billion a month as the shortfall, obviously going down through the year as the economy recovers. Against that $20 to $30 billion shortfall, we are putting $2.8 trillion, or about, whatever that is, about $250 billion a month. Now, in part that's because the stimulus is the reason why the shortfall was projected. But the main thing to understand is that the stimulus is vastly disproportionate to the lost income from COVID. It is much more than the amount of income that is being lost. So household incomes, the lower you are, the more true this is. Household incomes are vastly greater in 2021 than anybody could have expected them to be before COVID. So we're doing something quite disproportionate. My main view is that we're making a mistake. Why are we making why are we making the mistake? Some of it is that it hasn't been a great period for conventional sound economic advice. That's why we got that's part of why we got Donald Trump elected. That's the lesson many people drew from the financial crisis. So, you know, as I said in a different context many years ago, it's not an accident that there are no quack cures for broken arms or strep throat. And there are a lot of quack cures for cancer and for the common cold. And so when orthodoxy doesn't produce outcomes that people like, there's a tendency to gravitate to unorthodoxy, and sometimes that unorthodoxy is right. I think there has been a complete failure to impart a quantitative dimension to the discussion of economic policy. What has stunned me about the administration's rhetoric, frankly, about Paul Krugman's rhetoric and discussion of these issues, is that there are no arguments made in favor of the $1.9 trillion package that would not also be arguments for a $5 trillion package or a $10 trillion package. There are qualitative arguments for taking a much more Keynesian approach than we have taken in the past. And anybody who's listened to me at these conferences over the last 30 years knows that I've usually been on the side of taking a significantly more Keynesian approach. How could I turn out to be, how could this turn out to be wrong? And what I'm saying turn out to be wrong, and there's a panacea. It could turn out that the economy has vastly greater potential, that that demand creates its own supply, and that vast increases in demand will call forth vast increases along some kind of highly elastic aggregate supply curve without supply. To believe that, you have to believe that either there's been a productivity miracle in the last 2 years, or that in 2019, when the unemployment rate was 3.5%, we were operating way below capacity. It could be the case that the economy has been much more secularly stagnant for much longer than I dared to suggest previously, and that big increases in demand are therefore just what the doctor orders. It could be, this is probably the best defense of current policy, that we can't really manage the fiscal policies that are appropriate on an ongoing basis because the austerity advocates are too strong. So, but if we just give people huge amounts of money this year, they'll spend it gradually over the next 10 years. And so we'll get the spending expansion that we need. And that the only politically feasible way is to link it to an emergency, albeit disproportionately an emergency. That would be a story for understanding this, but I don't understand the rest of it. And I also don't understand why, in a country that has all the problems the United States has, the major high priority use of $1.5 trillion in resources should be improving the balance sheet position of the household sector, which is the argument being made by people who advocate this plan on the grounds that the multiplier will in fact be low, so you don't have to worry about overheat. And this will improve the balance sheet. My question would be, wouldn't we be better off improving the infrastructure? Wouldn't we be better off with a set of investment activities? So those are some reactions to what you've asked.
Richardo, just taking off from what Larry just said, you've talked about prioritizing spending. I mean, clearly we've spent the initial dollops of money to prevent scarring, making up balance sheet losses, both for firms and households. And of course, there are some new welfare programs which have been initiated, ostensibly temporary, but may be more permanent. Now, what else do we need to spend on? We have the investment, both in human capital as well as in physical capital coming down the line. We have potential stimulus. There is also perhaps spending needs, for protecting against climate change, for changing the economy to a green economy. How would you prioritize amongst these? And do you think that we have enough room to do everything?
Let me answer that while also responding a little bit to what Larry as well as Carmen said earlier, adding some. I mean, in part, in my initial intervention, I, while from a very different perspective from Larry, already partly answered that question. I already said that, looking forward at the stimulus, what I call the second trade-off, more than thinking in terms of MPCs out of income, it's really about the MPCs out of the household balance sheet. As I said, I think the type of models that explain the increase in the balance sheet that we've seen, whether one takes a more buffer stock model of the world or even a more Ricardian model of the world, neither of them justify a large increase in household balance sheets going forward, and both predict indeed there will be potentially a very large amount of spending coming soon. So even if I'm coming at it from a very different angle, I think from what Larry did, I end up, I think, finishing in the same spot, which is it is hard to justify why giving checks or to the household balance sheet would be important now. Whereas, as I noted as well, when one looks instead from a sustainability of the debt perspective, which was again the very different perspective from what Larry used, but which I use in my intervention, it also seems that thinking about how to increase the marginal productive capital in the economy, if indeed interest rates are about to rise, and I think that's a possibility, even if secular stagnation continues to be the true, but even if solely because of the stimulus and other developments, we have some increase in interest rates, then I would be really focusing on things that increase the marginal productive capital, because otherwise the US, following a little bit what Carmen said, can itself find itself in some fiscal trouble. So it would be things, I would be focused on gaps on marginal productive capital. Maybe that's infrastructure, maybe not. Again, we can discuss the different ones, and climate being a potential example of that. So that would be kind of my immediate response to what you said, which is that I start and use a very different frame of mind than what Larry did in my intervention relative to his, but we do end up actually, perhaps surprising, perhaps not, in a very similar prescription when it comes to the near future. Now, I wanted though to likewise, though, comment on two things, both your question to Larry as well as Carmen's intervention. First, is the world different? So Larry answered to you in the sense of policy. Let me answer instead from a perspective of economic models, if you want, which I think, given our audience, some people at least will appreciate. I used to think of business cycles, or I think the way in which we've been trained about business cycles, and there's some trend level of output, and there are some fluctuations around it. The goal of counter-cyclical stabilization policy is to diminish the amplitude of those fluctuations, but modeling them as, if you want, Brownian motion type shocks, or to a trend line with more or less reversal, depending on what we may discuss, was roughly what then policy was about, was diminishing the amplitude. I think if you look at the last 20 now plus years, we see on the one hand, great moderation. The volatility quarter to quarter, year to year is lower. Recessions happen much more infrequently. But when they happen, they're now much bigger. We had a great financial crisis 10 years ago, and now we had a great pandemic. If I was to do a simple time series model of output now, I would have a constant, again, trend, and every so often a Poisson shock, not a Brownian motion shock. Now, we learned, I think, in 2010 from the research after that understanding the non-linearities that come with Poisson as opposed to smooth, continuous path, smooth Brownian motion shocks can actually be quite different. We understood that the responses may be different. I think also with this pandemic, we'll also understand that in a sense, the impact, things like precautionary savings, the impact of large shocks on balance sheets of households and how different sectors are affected, I think will be important. So I do think that our policy prescriptions change. Having said that, again, I don't think they change to justify what's being done in the recent past, but I do think they change. I think that's a big challenge to the many participants in this conference, is that I think the way we'll model those fluctuations should change somewhat and think more in terms of large infrequent shocks rather than recurrent fluctuations. And then thirdly, on what Carmen said, I really want to emphasize something she said, which is sometimes the great belief that the treasuries, US treasuries and the dollar are the supreme pillar, safe financial asset in international financial architecture. I think in some ways we've grown to not question that in any way. But I think looking forward, and I think the last 12 months have really, at least to me, shaken that belief that that is not just a stable equilibrium, but the only possible equilibrium. We have seen some small cracks in the treasury market, showing that the plumbing in treasuries is somewhat more fragile than we thought. We have seen that the foreign demand for treasuries, usually I always thought, in a crisis, you have flight to safety, money flows into the US treasuries. Money has flown out of US treasuries in the last 9 months, justifying, for instance, the FEMA repo facility and others at the Fed. But more generally, it's continued to flow out. We're used to seeing, well, domestically, there's always robust demand. And yet what we've seen is the Fed absorbing more than half of the supply of treasuries in the last few years. That US governments in the tradition of Alexander Hamilton are always about being very fiscally responsible. I think we've seen, and talking immediately about how we're going to adjust for excess spending. We're not seeing much of that. And finally, fifth, that unlike what happened 10 years ago, when there was no alternative to the US dollar, in part because the euro and the ECB had responded in a way that made the usage of the euro more difficult, given the sovereign debt crisis, as well as, for instance, the delay that the ECB had in extending swap lines, unlike the US. What we see now is that an RMB that was 0 is now 4 or 5% and is fighting certainly for some part of international payments at different times. We see the euro, we saw the ECB extending swap lines and others in a way that tries to create the euro-safe asset. So there's now some alternatives. More importantly, Raghu, and to conclude that point, let me be clear, maybe the right policies for the US, I think they were to run very large deficits. And for the perspective of the US wealth, for inflation output, it has been doing what is right and using the treasury market as it should. But I do recall, or at least my economic history points me to what happened around 1970, around the collapse of Bretton Woods. When likewise, following with the Vietnam War, the US pursued domestic priorities, and that led to a shakeup, a change in the international financial system. Note that 1970s did not mean that the dollar stopped being central. And so I'm not in any way saying the dollar is about to start being central, but it started being central in a very different way in post-Bretton Woods than pre-Bretton Woods. And I do wonder whether, in line with what Carmen was saying, that there are many cracks in international financial architecture, and that the role of treasury in the dollar may be itself for a change in the next few years.
Carmen, I want to, you mentioned central banks, and there's a lot of belief that this new cooperation between the Treasury and the central banks will also play out as interest rates start rising, whether for inflationary reasons or because real interest rates are moving up. Somehow market participants are looking at the central banks as intervening yet again in long-term interest rates, and expecting that they will stay on hold, even as they see inflation pick up. And many of them have said that we will be patient. What's your sense? Have central banks got enough independence that they will break at the right time? And then to Richardo's earlier point that, part of how the central banks intervene, if they intervene directly in markets to keep long rates down, expanding their balance sheet, is really by shortening the effective maturity of the consolidated debt of the central bank and the government. Doesn't that have risks of its own? Maybe not when the central bank has 20% of government debt, but when it starts getting to 30, 40, 50, doesn't that expose the consolidated balance sheet much more to increases in interest rates and perhaps in negative dynamics? So this is really a question to ask you to opine more broadly on central banks.
So let me start with the where Richardo left off on the issue of the dollar, and this will take me to the Fed and the central banks in general. Look, even assuming the dollar, perhaps I didn't make this clear, even assuming the dollar remains the reserve currency, that it is not supplanted by something else. We've had spectacular crashes in the dollar before. And you know, the breakdown of Bretton Woods, in effect, you know, this goes to your question directly, Raghu, of what was the role of the central bank? The idea that central bank treasury cooperation is a new phenomenon is kind of fiction, right? I mean, of course, during World War II, you had ceilings, and these ceilings on long bonds persisted into the 50s. I remember people saying, wow, when the BOJ introduced a ceiling on the long bond, that's a new one. No, it's not new. And in effect, the issue that Larry mentioned, that you know, when certain conventional things don't work as well, you start to get more unconventional. Everyone remembers the 1951 Fed Treasury Accord as the establishment of real central bank independence. What people do not remember, and I've alluded to this, it's also in my paper, The Liquidation of Government Debt, is that in 51, at the time of the accord, both the Fed and the Treasury were very preoccupied with the fact that the US still had a very high level of debt from legacy of World War II. The economy has started to pick up, and interest rates, short-term interest rates, had started to pick up. And this is germane to also your comment about maturities. The lesser known part, and you can check out the minutes of the accord, was actually a debt conversion in which short-term treasury held by the Fed were converted to a 29.5-year bond, non-marketable bond. So, you know, I think but this goes to the issue that Fed Treasury coordination persisted under the even keel policy for a very long time. The bottom line I am suggesting is that I am not looking for a change de jure on central bank independence, but de facto, absolutely. And de facto, I think we started down that route in around the global financial crisis, when really monetary policy became more and more like fiscal policy with redistributive effects. And I hope we do get a chance to talk about taxes, because, you know, we talk about inflation on one hand as you know, or we, you know, the consequences of high debt being inflation or austerity. In the end, you know, debt is being always brought down by one form of tax or another, whether it's the inflation tax or more orthodox taxes. But I'd like to talk a little bit more about that perhaps later on.
Well, we have fairly limited time before we go to questions. So I want to give you the opportunity, and then if you can spend a couple of minutes, let's keep the next round of answers short. How do we bring down this debt? You know, we certainly have massive levels of debt on government balance sheets, but private debt has also gone up. Corporate debt gone up by about 10% across the world, 10% to GDP over the course of the pandemic. Household debt by about 5 to 6%. So massive increases in debt. How does this get down other than through inflation?
So look, Raghu. What is the menu? The menu is, in the best of worlds, you grow your way out of it. You know, this is the scenario of what Larry was saying. What could be the surprise? That all of a sudden, you know, potential growth is a lot higher, and then we grow our way out of it. I don't attach a high probability to that being the major driver of reduction. The second is we stop acting like in the US, like we've acted over the last few decades, and actually do something closer to at the end of the war, which is we run balanced budgets for a while. And even with some growth and modest inflation, you know, the debt starts to work down. But that also importantly involves taxes. So that I think it's a tax story rather than a reversal, a draconian reversal in expenditures. Then, you know, you have the inflation tax, which by the way is very regressive because, you know, lower income households don't hedge the way that, or don't have the capacity to hedge the way higher income households. So inflation is a tax. Financial repression is a tax, which I think it's not that we will use. I think we've been using it for over a decade. It is a transfer from savers to borrowers, and specifically a tax on bondholders. And finally, my point about periphery Europe, debt restructuring. Debt restructuring is a tax. It's a haircut on the bondholders or, you know, the creditors. But they're all taxes. So that's the summary of how I think the end game, what the combination of orthodox versus less orthodox taxes are, but it's all about taxes.
Yeah, it is interesting, this issue of higher revenues. There's a lot of faith that whatever is implemented now will stick. But of course, we could have a change in administration, certainly a change in Congress. And then, you know, the question is how much these tax raising measures persist. Larry, I want to just shift a little bit from the US just to bring in the rest of the world. You recently worked on a report on debt around the world and relief measures and so on. What is your sense on where the rest of the world is and what can be done both by multilateral institutions as well as on debt relief?
I think the world has lucked out on debt over the last year. The industrial world boomed much more than people expected. Risk appetites came back much more quickly. And so the wave of defaults that many people feared did not get better. The basic reality of the international debt architecture, that more of the holdings are by private bondholders who set up their holdings so they can't be negotiated with. More of the debt is held by the Chinese who don't participate in the existing international fora. And more of the debt is quasi-government guaranteed private debt or local currency debt in the developing countries, means that if we were to have another serious period of emerging market financial distress, I do not think we have a remotely satisfactory architecture for working it through with any speed at all. There is a deep tension in this area that planning for defaults, it is widely feared, probably correctly, will encourage defaults and make defaults more likely. And so nobody wants to do it. The borrowers don't want to do it because they don't want to pay the higher interest rates. And the creditors don't want to do it because they don't want to encourage the defaults. And so everybody kind of pretends that there aren't going to be defaults. And it's allowed, it's a little bit, you know, it's handled in the same way that kidnapping policy is handled. Nobody wants to establish policies for paying ransom in time of kidnapping. And the same philosophy operates vis-a-vis defaults for more or less the same reason. But it's a big problem, and I would say the single biggest global financial gap that I see is actually something different, but I'll take this moment to say it. For $10 billion a year, the world could materially reduce the probability of there being another COVID epidemic in the next 20 years. My sense is that the return time for COVID type epidemics is on the order of 15 years, that we probably could make it 25 to 30 years for $10 billion a year, and that we are not on a path to allocating those funds as a global system. And that would be my single biggest priority if I were making policy at the spring IMF World Bank meetings.
Thanks. Let me go to the audience questions, and perhaps, Bob, you're first on. Bob Hall.
Okay, thank you. So thinking about Larry's review of U.S. Fiscal policy, first of all, it seems kind of obvious that the huge expansion of aid to families has demonstrated that the marginal propensity to consume under those conditions is way lower than we thought. The evidence for that is it didn't trigger, it should have, but it didn't trigger the big expansion that Larry's so concerned about. Yeah. It seems to me that, well, let me finish, Larry. Let me finish. So in terms of where the US economy is today, judged by unemployment, which is generally regarded as the best measure of the cyclical stance, we have 4.9% unemployment among people who don't have jobs and 1.1% among people who do have jobs. That 1.1 is going to continue to decline, and it's been declining. And that will no longer unemployment of people with jobs. They're getting their jobs back. That leaves us kind of in the middle in terms of how you would rank unemployment of 4.9%, a number which is likely to continue to decline, but very slowly. So the basic reading that we're at, I believe, the natural unemployment rate of which is currently about 4.9%. So there's no sign of the tightness in the economy that would trigger inflation that Larry's concerned about yet. The Fed has wisely adopted a policy of saying, well, if this inflation is going to come around for once, let's wait till it actually happens. And I think that's smart. But since the fiscal expansion of the debt, handing large amounts of the debt to individual households, doesn't seem to gain anything, but it does obviously tie our hands for the future in terms of what appears now to be a completely unsustainable growth of debt. If you look at the CBO's projections of debt, it just goes off to infinity. That's obviously not sustainable. The big concern that I would have is there so far just tiny trembles of lack of faith in the U.S.'s ability to repay its debt, but keep your eye on that. Richardo mentioned that, but it's certainly the thing to watch out now is the world losing its faith in the U.S.'s ability to pay off all this debt.
Larry, then Richardo.
Sorry, you call me?
Yeah, you want to respond to that?
Yeah, sure. Look, Bob, the question is, I'm surprised that you're so confident. Lots of people are predicting 7% growth this year. I wouldn't have expected, if we're at the natural rate now,
yeah,
then I would think after we had 7% growth this year and 4 or 5% growth next year, that we'd be in a pretty problematic, we'd get ourselves to a pretty problematic place. Maybe the Fed will raise rates sooner because it'll see the inflation and achieve a so-called soft landing. Maybe the idea that the fiscal policy is ending, therefore we're going to have lots of contraction next year, doesn't really work if your theory is that the fiscal policy is mostly not getting spent and is going to get spent over time. I agree with something Richardo said. Richardo emphasized, and I don't think the profession is well calibrated on this. How should you think about households that receive checks this year and don't spend them? Should you think on one extreme, well, that's going to be wealth and the marginal propensity to consume is 5% out of wealth? Or should you think in some buffer stock kind of way, or some deleveraging and then releveraging kind of way, that it's going to be that marginal propensity is going to be more like 20 or 25%? My hunch, more informed as a hunch from anecdotes than from optimizing models, is in line with Richardo's buffer stock model, that you're going to have a pretty high propensity to consume. So it seems to me that I would have expected that we wouldn't have inflation yet, and that we're going to have the mother of all booms for the next 18 months to 2 years, and that's likely to generate some kind of inflation and uncontrolled breaking. And I've argued in the past that the Fed should avoid being preemptive with respect to inflation. But God, with 18%, with this kind of boom forecast, I mean, I'll give you a bet that's available. Markets are saying that the odds are about 1 in 15 that the 10-year will be above 3% 1 year from now. I would have thought the odds were about 1 in 3.
You've left out something critically important, and you mentioned these forecasts of growth, but a major supply shock is impending, and you've left out supply shocks from your analysis. There's nothing extraordinary about growth.
I'm not sure what the major supply shock exactly is. I'm assuming that, contrary to all the talk about scarring, that potential growth, the potential in the fourth quarter of this year will be 3.5 to 4% above where potential was 2 years prior, just before COVID, in the fall of 2019. So yes, if the view is that COVID's got us all using Zoom, and so it's induced a major positive productivity shock, I am leaving that out. I'm leaving it out if you think that by killing a lot of zombie firms, COVID has produced a major supply shock. But I'm assuming supply shocks at the level of eliminating 100% of the scarring from COVID.
Richardo, you want to come in?
I want to pick up on the inflation thing that came up in Bob when he said, well, I think the Fed is doing the right thing, or at least waiting for it to happen. And that's come up also a couple of times in the discussion so far. So let me try to describe what I think about inflation, or how I look at inflation right now. I mean, we have to start from the fact that we have 20 years of a capital earned with great sacrifice, if you want, by central banks, that has made inflation expectations, certainly long inflation expectations, be essentially anchored at 2% plus white noise, if you want. Now start from that. Well, then let's look at our 4 leading theories, or our 3 leading theories of where inflation will come. First, the Phillips curve view of the world. Well, with inflation expectations this well anchored, then we have a very static Phillips-like Phillips curve, and then it will be whether the output boom leads to inflation. And on that, I think many estimates on the slope of that Phillips curve are relatively flat, so not a lot would come in the short run. But if there's an increase in inflation, that can precisely lead households to wake up from their rational attention of the last 20 years, or they've stopped paying attention to inflation, we've stopped having any kind of wage indexing in the economy or not, and start upgrading to do that. And we would shift from the static Phillips curve to an accelerationist Phillips curve, in which case inflation, once it increases, then increases in an accelerationist path, and then becomes very hard to stop, as we learned, for instance, post-1970s. Second theory of inflation, a more monetarist theory. As I said earlier, now we have households depositing very large amounts at the central bank, at banks, we turn deposit central bank, in which they potentially will be withdrawing in the next few months. Now, if they're withdrawing and turning them into spending or investment in other nominal assets, but in particular, if expected inflation continues to be well anchored, well, not much. Velocity fell a lot. Velocity will increase some, but not much inflation. But if there is, again, a perception inflation is on the rise, the withdrawal of deposits in nominal terms at banks will mean putting them instead into real assets. And as substitution from nominal to real happens, then we will have, again, inflation increasing and increasing in ways that are accelerating. Third, fiscal dominance. Theories of inflation based on fiscal dominance. And Carmen has already touched on these. The key question there is, if inflation increases somewhat, will the central bank raise interest rates, as it has convinced us it always will, or instead, as Carmen was noting, well, but look at history, whenever debt is very high, central banks are very weary of raising interest rates. They're much more happy to put ceilings on interest rates, not raise them at all. Now, I don't know what will happen. I will note that certainly the statements from the Federal Reserve, Bob, as well as from the ECB and from the Bank of England, so not to pick just on the Fed, are the most dovish I've seen in 30, 40 years of reading statements. I mean, there's barely any statement of inflation. When anyone ever brings up inflation in a press conference nowadays, they're told, why are you talking about inflation? Let's talk about unemployment and inequality and whatnot. So we do seem to see a lot of dovishness there. So while I agree that, yes, we shouldn't put on the brakes too early, I think that's a mistake that's very often done. And that while inflation expectations are anchored, that is the right thing to do across all the main theories of inflation that I carry in my mind, as well as across, I think, what is the historical record in the empirical evidence. The key is to see when inflation expectations become unanchored. And once they do, they are very hard to bring down for the fiscalist reasons, for the monetarist reasons, and for the Phillips curve reasons.
Carmen, I want to give you the last word because we're running out of time.
Raghu, let me just interrupt for one moment.
Yeah.
It's just Marty. This is such a terrifically interesting session that if the panelists and you are happy to go on a little longer, we are certainly happy to allow that to happen. So I would not want to prematurely, give it another 5 minutes or something, if that's
okay. Let's go for another 5 minutes. We'll take another question after this. Let me just give Carmen the chance to talk about two things. One, maybe respond a little to what Richardo said, if you want to amplify on that. And second, one set of countries which have been left out of this whole debate are the developing countries. As chief economist for the World Bank, would you want to talk a little bit about their situation right now?
Okay, so one thing that I'd like to mention in the discussion also, just before turning to that very quickly, we've talked a lot or heard a lot about the fiscal impulse, the monetary impulse. I was surprised to hear Larry thinks there is no scarring. We do have substantial forbearance policies on the financial side that are temporary. Some of those debts are going to have to be repaid. I think there's a lot of small and medium businesses where we are grossly underestimating the number of bankruptcies and so on. So what I'm throwing out there is, I think there is the view that we're in for an upsurge. I think that's not being debated. I think how sustainable that upsurge is, I do question. And I do question it on the grounds of some of the financial fragilities that I think will be legacy of COVID. But let me turn I want to bring up the issue of especially the emerging markets and developing countries. This is the discussion we are having here would be the envy of any country to be discussing this. You know, oh, are we going to overheat so that inflation goes up? What they're seeing is actually, inflation going up in many cases with, very negative growth prospects. The issues are many, but about half of the low-income countries entered COVID with already pre-existing debt problems. At the moment, more than half of them are either in debt distress or quickly approaching it. I think the bottom line, Raghu, is that the recovery, and I thought the Larry's report and the Group of 30 did an excellent job on, and I agreed with like 99% of it on the dealing with the debt side. I think dealing with the debt side is filled with hurdles. I don't see that getting, the debt overhang for the developing and emerging getting resolved soon. So I think the growth, the balance towards lower growth and higher inflation, I think the canary in the coal mine on inflation is going to be in the emerging market developing countries sphere. Let me stop there.
Right. Let me take the questions. If we have three people who want to ask questions, Michelle, Alp, and Mervyn. If you could ask your questions as succinctly as possible, then we can just open it up for a last round of responses from the panelists. So, Michelle?
Yeah, so my question was on the, so Larry pointed out to the unusually large stimulus, and there was some debate on sort of what the point of the stimulus, is it working? So I was wondering, wasn't part of the purpose of these checks also in some sense for political economy reasons? So we're closing lots of businesses, we're telling restaurants and hotels to just stay closed. We need people to adhere to all these social distancing policies. So aren't we in some sense buying the ability, that everyone is participating in this with all this money? So aren't these policies, isn't one benefit of the policies also basically lower infection rates? And hence we basically say, bought a lot of lives with the money. So it's a very different kind of stimulus. So I was wondering what people's thoughts were on this.
Yeah, I think the political economy of the stimulus is fascinating, right? Trying to figure out why exactly under these circumstances. Alp?
So it's a question for Larry. It's related to what Michelle said. So one driving force behind secular stagnation is rising inequality. It has grown and weighs aggregate demand down. And I think there's every reason to think that it will keep growing from what we know from labor economics. Now, if you take the view that that is a key driver of secular stagnation, and if you add on top of that the fact that the pandemic hit low-income households harder for a variety of reasons, and finally, if you also add that these packages have big relief and redistribution elements, they distribute to low-income people, does that change your view on the social value of these packages, as well as how they might affect aggregate demand over a longer horizon, especially if households use them to build up their balance sheets? They might not be the ideal solution, but it seems to me that they help at the margin if that's a key driver of secular stagnation.
Mervyn?
I think it helps to think about the particular shock that we've experienced. The Office of Budget Responsibility in the UK had a very interesting chart where they plotted the movement over the last year or so of aggregate demand, GDP, and a separate line on the chart for potential output. If you look very closely at the chart, you can just about see some small differences between the two lines, but very little. So if aggregate demand and potential output have been falling sharply, then recovering, then falling again, and are expected to rise again in tandem, Larry must be right in saying, what is the case for a large fiscal stimulus or indeed a large monetary stimulus to try to close that gap, which is probably relatively small. So Larry's point about the mismatch must surely be right. If you look back at the way that Europe handled it, you could explain the very large deficits in terms of transfer payments from taxpayers at large to businesses to enable them to maintain paying wages, even though revenue had fallen to zero because of government decisions to shut down parts of the economy. So during the period of restrictions, I think it's very easy to explain why you get large budget deficits. Once you end the restrictions and come out of that period, it's very difficult to justify the scale of fiscal stimulus or indeed monetary stimulus to which Larry has rightly drawn attention.
Steve Davis, if he's still there, he had raised his hand sometime.
Raghu, thanks. My question's already been covered.
Okay, so let's then go back to the panelists, starting with Carmen, and in reverse order, we'll end with Larry. Carmen, last closing remarks.
So, look, I think that the pandemic will leave different kinds of scarring, and I am not really sure on what the supply side may look like. But as I noted earlier, I think, you know, the inflation can come about because of overheating, but inflation can also come about because of central banks drag their feet and react slowly, and the markets basically lead them by the nose, which was the experience of the 60s. So I think because the world at large, I mean, what we're seeing is, sticking to the theme of debt, is, you know, you buy an antique teacup and it's tiny, and then they get bigger in the post-war, and now we drink tea out of buckets that are the mugs, and this is what's happening with debt. The both in the advanced and in the emerging world, the pandemic has left us with a much higher legacy of debt. And as I noted earlier, I do think that that does constrain policy. So, you know, my own view is not a particularly optimistic one. I have concerns about the sustainability of the recovery. And I have concerns that we are going to be shifting to higher inflation, higher tax rates, and more, you know, a sustained sort of muddling through environment, that we will be in that mode. And in that mode, accidents, one becomes more accident prone. That's the multiple equilibria of being in a vulnerability region.
Thank you, Carmen. Richardo.
I wanted to follow what Michelle said, which I thought was just right and very insightful. But there's both a benevolent and a malevolent way to think about that political economy. The benevolent one is to link what just happened in the last 12, 18 months to what happens whenever there's a world war or even just a large war. That's exactly what we say. We send the young men, and nowadays we send the young women as well, to war. We accumulate a large amount of debt to tell them, you're not going to be taxed by having fought this war. We're going to pay for this over the next 30 years. Future generations will pay for the peace we've left us. That's the benevolent perspective. And as you said, it justifies having a large amount of debt. And I would add, by the way, that if indeed our secular stagnation forces, and this linking a little bit to what Alp was saying, and inequality and others persist, then we can perhaps live with 120, 130% of debt GDP in the US that's only gradually brought down without any large increase in tax or inflation. So I'd have a more optimistic view than say what Carmen does. Note though, that even with that benevolent view, that requires looking forward that we have a sustainability plan for paying that debt. When one looks at the end of World War II or any other large war, what sees a clear distinction between countries that either are like the US post World War II with sustained balanced budgets with a clear plan on how to pay this over 10, 20, or 30 years. And one sees many other countries that did not go that way, that did not have the plan to do it. And as a result, or unable to convince markets and investors that would be the case, and that end up having very troublesome debt crisis times, much more like what Carmen was describing in the years following a war. Now that's the benevolent view. The malevolent view, Michelle, is that story that the current generation must be rewarded for the sacrifices it's doing, either in response to a shock or because there's a great structural transformation going on that will pay great dividends, is exactly the story of every Latin American country in the 1980s and 90s that ended up with hyperinflation. It's always the story that the current generation, we're doing reform, we're fighting communism, we're starting a new regime, we're moving in some way, we're going to accumulate a lot of debt. This is just like a war, it's a dividend that will be paid. And then, again, without any plan to regularize public finances, you end up with a crash. Thank you.
Thanks, Richardo, for those hopefully not prescient remarks. Larry.
Thank you. Thank you, and thank you for the discussion. I won't respond to Mervyn since he agreed with me in what he said, other than to say that I agreed with him. With respect to Michelle's question, Michelle, that's why your reasoning was part of why I was wildly enthusiastic about the stimulus package last year. If you look at the stimulus package this year versus the amount of staying home that people wanted to purchase or could sensibly have wanted to purchase, I don't think you can explain a large part of the $2.8 trillion on the basis of your kind of argument. Alp, I agree with your basic point as part of what I always talked about as regards secular stagnation. And in a way, you're saying something I said, which is if all this works well, what it will prove is that the secular stagnation forces were much greater than I dared to imagine that they would be. And that is certainly a possible outcome. I would highlight the tension between in the discussion of this. The administration can't quite decide whether it thinks that these are temporary measures so you shouldn't worry about inflation, or whether these are the most important revolution in social policy since the New Deal. They can't very well have it both. I think it's worth remembering, because people don't, that child credits to children in poverty represent 1.5% of the $1.9 trillion stimulus. I think they're a fine idea on social policy grounds. I'm in favor of it. It's fine. But to allow the whole thing to be seen that way is, I think, a complete error. So that basically where I'm on that. I guess the last thing, I thought Richardo's summary of you can have any different theory of inflation and you still should be worried was exactly to the point that I had gone through exactly the same kind of reasoning myself. I don't understand why people who are aware of the Vietnam War experience and who listen to the declarations that it's a whole new era at the Fed, IMF, and in social policy should think that expectations will be anchored for a long time. Everything that is being said about the posture of policy in the United States is about how this isn't a war after which we're going to return to normal, but is instead a new normal. For the first time in history, we have a Fed whose rhetoric is no longer directed at preempting inflation, but is directed at preempting the idea that it might get afraid of inflation. And that seems to me to be a quite scary thing. And finally, I want to associate myself with something Richardo said about the right way to understand fluctuations. My almost totally unread Brookings paper in 1989 with Brad DeLong basically made a very similar point. The literature on plucking makes the point. And the way I like to make the point is to say, suppose you were given a time series on the body temperature of a human being. What would the right way to analyze it be? One way would be to look at a lot of cyclical components. There was the daily component, there was the monthly component, there was the secular component, there were a lot of things. Another way to look at it would be that there were these periodic spikes upwards that were hard to understand, that could be grouped into several different syndromes that produced upward spikes. And you could think about how to contain them. That there was no particular notion of a downward spike that was parallel to the notion of an upward spike, and that the job was to figure out how to contain the episodes that produced the upward spikes. I think that is the way the science of medicine proceeds, to our great good fortune. And I think the study of macroeconomic policy around short-term fluctuations should have that orientation rather than the orientation we have been misguided to towards focus on the second moment and towards variances. I think that's what you were trying to capture, Richardo, with your reference to Poisson events rather than cycles. But think about the unemployment rate in the way you would think about the fever chart will, I think, lead us to be more fruitful and useful in the future.